Hello and welcome. With over 35 schemes already competing for investor attention, Flexi Cap is one of the busiest mutual fund categories today. Yet, that's exactly where the wealth company has chosen to make its debut. Joining me is Aparna Shanker. She's CIO Equity, and she'll talk about the timing, the strategy, and what makes their Flexi Cap fund different. Welcome, Aparna.
Thanks, Abhijit.
Great to have you here. Aparna, let's begin this conversation with, your fund house is entering the mutual fund industry now when the competition is intense and investors already have plenty of choice. So why this timing and what is the core idea behind the wealth company's entry?
This is a great opportunity to connect with the investors and investment intermediaries also. So just to give you a little background, Pantogmath Group is known for its strong track record in investment banking, capital markets, and financial advisory. And I think mutual fund entry is a natural extension of their aspirations in the with the core competencies. Just to give you a brief about, they're already managing a 10,000 crores of assets, clients' assets. Of that, AIF is has a lion's share of almost 8,000 crores.
Okay.
So this AIF is a category 2 AIF, which means that they invest majorly almost 80% plus into unlisted companies. And the core strength, what I feel is that they're, kind of analyzing businesses from tier 2 and tier 3 cities and investing into those businesses. Another thing which was noteworthy for me and even for investors is that all in the Series 1 AIF, they have returned almost 60% of the capital to the investors in a short period of 17 months. I think that talks a lot about their strength. And when you talk about AIF, it is a 1 crore ticket size. They also have PMAs, which is a 50 lakh ticket size. So, I mean, there is a product gap and their, intention to service the retail investor is paramount. And that's how the entry into mutual fund, because here there is an opportunity to serve the retail investors which are being underserved from tier 2, tier 3 cities. I think that's the objective.
Right. Now, moving on, of all the categories, you've chosen FlexiCap as your debut. So why FlexiCap, and how do you want to, how do you want it to sit in an investor's portfolio?
Yeah. So SEBI has standardized almost all the products. In fact, all the products. And I feel, and we as an organization also believe that FlexiCap is that category of a product which every investor should have as a core portfolio. Core part of their portfolio should be a FlexiCap. It's a classic product. It's a all-weather product because the fund offers the flexibility to the fund manager to switch between different market caps depending upon the emerging potential to invest or emerging potential to generate better returns. I think that kind of a flexibility no other product provides, and that's why it is an important and core part of the portfolio of every investor. That's what we believe.
Right. But there are already over 35 FlexiCap funds. So
Yeah.
what is the white space that you are targeting, and why should a thoughtful investor add your fund rather than another existing one?
Great question. And there are 38 or 39 FlexiCap funds already in existence. First thing is that FlexiCap, as I mentioned, is a classic product. So from the investor side, I think there could be a lot more appetite for this product. That means that the universe of the FlexiCap as a manufacturer is very huge. And that also means that without competing for kind of a market share, everyone in this category will have a good market share without creating a higher competition. That is one thing. Another thing which I said, as you said, already there are multiple number of FlexiCap funds. And that is a big advantage for us because we are learning from their positioning, their, kind of where they have faltered. And that is the learning curve we have, which is a better than anybody else.
Okay.
When we were launching the FlexiCap product, we analyzed the other FlexiCap products, and what we realized is that almost 60 to 70% of the funds are rigidly positioned into large cap category, and some small exposure of 10 to 30% to mid cap, and maybe smaller than that to the small cap. So our first learning is that we will be more agile to take advantage of this investment product by switching in a more agile way between the large cap, mid cap, and small cap, wherever the better potential or better opportunities emerge. The second observation and also the second learning for us was that most of the funds have more than 60 number of stocks. Okay. So what happens with this is that one is the tail is very long, and there is no benefit of diversification anything beyond 30-35 number of stocks. That's where the another thing which happens is that the intensity with which you track the higher weight stocks, you tend to lose that kind of an intensity, because it is humanly not possible to kind of track 40, 50, or 60 number of stocks with the same intensity, and that's where the accidents happen. I think this was the second learning, and we are targeting to have an optimally diversified portfolio of 35 to 40 number of stocks, where the stocks will be high conviction, bottom up stock picking, and will have a meaningful weight, to say that even we will have minimum 2% weight in every stock wherever
Okay.
we enter. I think that's how we are going to differentiate a lot.
Right. So that's also about your style and positioning. Now, moving on to risk and downside protection. So, volatility is the investor's biggest pain point. What is the practical mechanism for cushioning shocks and managing risks when the market turns rough?
Yeah, that's a good question. We tend to ignore this, but risk management is the integral part of the fund management. And it is not about, chasing the returns, but managing the risk effectively has to be a prime objective. And risk can be managed at, multiple levels. It can be managed at a portfolio construction level, and it has to be also managed at the portfolio monitoring level. So we as an organization has defined our investment philosophy, which is change with an overlay of age. Now to the word change, we every alphabet of that word, we have attached an important factor. Like when you say change, CHANGE, C stands for the capability of the management, H historical, operational and financial performance, A attractive valuation, very important. Unless and until you enter at a reasonably right price, your probability or your potential to generate better returns comes down. N is navigating the business across multiple cycles. We have seen COVID times, how business is navigated, in different pre-COVID era and post-COVID era. Then G for governance, it is important to look at it, how the majority shareholder has treated the minority shareholder. And then E stands for the earnings growth. It's also important to look into future, how the company is going to grow in next 3 to 4 years. These are all the factors which are related to internal to the company, internal environment of the company. And then there is an age overlay where, the factors which are not controllable by the management are which impact the valuation growth of a stock are, looked at, like exchange related factors, domestic factors, GDP growth, interest rate, global factors, FIIs, inflows, outflows. And then the last E, which is the most important E of the whole investment philosophy, is exit and rebalancing. From the time of the entry, or maybe at the time of the entry itself, we are mindful about the factors which are going to affect our decision to exit or rebalance a stock. That brings the agility, and I think with these factors or with the process what we are planning to follow, we will be better. We will able to manage the risk better is and the drawdowns better. That's what we believe.
Okay, so who should ideally consider this fund for? Is it for a first-time investor or better suited as an add-on for seasoned portfolios?
This is a classic product, you know, and this should be part of every investor who has a reasonably good risk appetite. But investment horizon should be more than 5 years. That should be that. It could be for the first time investor also if you have that kind of a risk appetite and the investment horizon.
Now, Aparna, if we were to meet again 5 years from now, what story would you like the wealth company Flexi Cap Fund to be telling?
Ah, great question again. I think I would go with one line: the agile journey of the youngest mutual fund from 49th rank to top tier.
All right, all the best to you.
Thank you so much.
So that was Aparna Shanker of the Wealth Company Mutual Fund sharing the thinking behind their debut and what investors can expect from their Flexi Cap Fund. Thank you for watching, and we'll see you in the next conversation.